Hello guys, hope you're doing well and everything goes great with you. I'm Zandi. Me and my friends Kian and Daniel are going to teach accounting for the beginners. I want to take this moment to thank our supervisor, Dr.RezaZarei, for his great help and support. The main source is Accounting Principle written by HORNGREN. Unfortunately, because of COVID-19, we have to prepare this lecture online and we do our best to make you understand accounting and its principle. We are students in University of Kurdistan and we do our best to make you understand. So let's do it. Our first video, the first chapter is about accounting and the business environment. The language of business. First of all, we want to define the word accounting. What is accounting? Accounting is the information system that measures business activities, processes the information into reports, and communicates the result to decision makers. Accounting is the language of a business. The better you understand the language, the better your decision will be, and the better you can manage your finance. A key product of accounting is a set of documents called financial statements. Documents that report on a business in monetary amount, providing information to help people make informed business decisions. For example, we want to know if a company making profit, should the company expand? And answering to these kind of questions call for the company's financial statements. This example illustrates the role of accounting in businesses. The process starts and ends with people making decisions. As you can see here, people make decisions, then business transactions occur. After that, business prepare reports to show the result of their operation. Then we will return back to the people make decisions. Decision makers or the users of accounting information. Decision makers need information. The bigger the decision, the greater the need. Here are some decision makers who use accounting information. The first one, individuals. You use accounting information to manage your bank account, evaluate a new job prospect, and decide whether to rent or buy a house. Business. Managers use accounting information to set goals for their organizations. They also evaluate progress toward those goals and they take corrective action when it's needed. Investors. What is investors? Investors provide the money to get a business going. To decide whether to invest, a person predicts the amount of income on the investments. Creditors. Before lending money, a bank evaluates the borrower's ability to make the payment. This evaluation includes a report on the borrower's financial position and predicted income. Government and regulatory agencies. Most organizations face government regulation. For example, the Securities and Exchange Commission, which is SEC, a federal agency, requires business to report their financial information to the public. Taxing authorities. Local, state, and federal government levy taxes. Income tax is figured using accounting information. Sales tax depends upon a company's sales. Non-profit organizations like churches, hospitals, and college use accounting information the same way as Amazon.com and Coca-Cola Company. Financial accounting and management accounting. Accounting can be divided into two fields, financial accounting and management accounting. So what is financial accounting? Financial accounting provides information for people outside the company. Outside the company. Lenders and outside investors are not part of day-to-day management. These people use the company's financial statements. And what is management accounting? It focuses on information for internal decision maker. Financial accounting is for outside the company, but management accounting is for internal decision makers, such as the company's executive and the administrators of a hospital. Look at this example about Amazon.com. Investors, they thought that should we invest in Amazon? Is the company profitable? These are the questions that may investors have. Investors use financial accounting information to measure profitability. And the other question which may creditors face are that should we lend money to Amazon? Can the company pay us back? So creditors use financial accounting again information to decide whether to make a loan. And the company use management accounting information to operate the company. Here is governing organization. In the United States, a private organization called FASB, which is the brief form of Financial Accounting Standard Board, formulates accounting standards. The FASB works with a governmental agency, the SEC, and two private groups, the American Institute of Certified Public Accountants, which is AICPA, and the Institute of Management Accountants, which is IMA. Certified Public Accountants, or CPAs, are professional accountants who are licensed to serve the general public. And Certified Management Accountants, or CPAs, are professional accountants who work for a single company. Both groups of accountants have passed qualifying exams. And the rules that govern public accounting information are called Generally Accepted Accounting Principle, which is GAAP. You can look at this picture. For private sector, professional accountants apply Generally Accepted Accounting Principle. Then the private sector, the Securities and Exchange Commission, which is SEC, a government agency, regulates securities markets in the United States. And the private sector, again, the Financial Accounting Standard Board, determine Generally Accepted Accounting Principle. Generally Accepted Accounting Principle, GAAP. Ethics in accounting and businesses. Ethical considerations affect everything accountants do. Investors and creditors need relevant and reliable information about the company, such as Amazon or General Motors. The companies naturally want to make themselves look as good as possible in order to attract investors. There is a potential for conflict here. To provide reliable information for the public, the SEC requires companies to have their financial statements audited by independent accountants. An audit is a financial examination. The accountants then certify that the financial statements give a true picture of company's situation. Standards of professional conduct. The AICPA's, a code of professional conduct for accountants, provide guides to CPAs in their work. Ethical standards are designed to provide relevant and reliable information for decision makers. The preamble to the code states, certified public accountants assume an obligation to self-discipline above and beyond the requirements of law and regulations. Management accounting have an obligation to the organization they serve, their profession, their public, and themselves to maintain the highest standards of ethical conduct. Types of business organization, which is proprietorships, partnerships, and corporations. Proprietorships has a single owner called the proprietor, who is often the manager, and they tend to be small chained stores or professional businesses, such as physicians and attorneys and accountants. And partnership. A partnership joins two or more individuals as co-owner. Each owner is a part. Many retain establishments and professional organization of physicians and attorneys and accountants are partnerships. Accountants treat the partnership as a separate organization, distinct from the personal affairs of each partner. So the next one is corporation. It's a business owned by stockholders or shareholders. These are the people who own shares of ownership in the business. A business becomes a corporation when the state approves its article of incorporation. A corporation is a legal entity that conducts businesses in its own name. Unlike the proprietorship and the partnership, the corporation is not defined by its owners. You can see here, for partnership, the owner. There is only one owner, and the life of the organization in partnership limited by owner's choice or death. And personal liability of the owner for the business debts prior proprietor um, is personally liable. And for legal status of the organization, the proprietorship is the prior, pri- proprietor. And for the partnership, there are two or more owners, and the life of the organization limited by the owner's choice or death. And personal liability of the owners for the business debts, partners are personally liable, and the partnership is the partners. For corporations, the owners are stockholders or shareholders. There are generally many owners, and the life of the organization is indefinite. And personal liability of the owners for the business debts as stockholders are not personally liable, and the corporation is separated from the stockholders. Accounting concepts and principles. The entity concept. The most basic concept in the accounting is that if the entity, an accounting entity, is an organization or a sector of an organization that stands apart as a separate economic unit. In accounting, boundaries are drawn around each entity so as not to confuse its affairs with those of other entities. The reliability principle. Accounting information is based on the most reliable data available. This guideline is the reliability principle, also called the objectivity principle. And reliable data are verifiable. The cost principle. The cost principle states the acquired assets and services should be recorded as their actual cost, also called historical cost. Suppose that you're considering the purchase of land for future expansion. The seller is asking $50,000 for land that cost her $35,000. An appraisal shows a value of $47,000. You first offer $44,000 and the seller counter offers with $48,000 and you agree on a price of $46,000. What dollar value of this land is reported on your financial statements? Which accounting concepts or principle guide your answers? We should say that according to the cost principle, assets and services should be recorded at their actual cost. Their actual cost. So you pay $46,000 for the land and reported $46,000. The going concepts. Another reason for measuring assets at historical cost is the going concern concept. This concept assumes that the entity will remain in operation for the foreseeable future. Under the going concern concept, accountants assume that the business will remain in operation long enough to use existing resources for their intended purpose. The stable monetary unit concept. A rise in the price level is called inflation. During inflation, a dollar will purchase less milk, less gas for your car, and less of other goods. When prices are stable and equals, maybe, when there is little inflation, the purchasing power of money is also stable. Accountants assume that the dollar purchasing power is stable. So it allows us to add and subtract dollar amount as though each dollar has the same purchasing power as any other dollar at any time. The accounting equation. What is assets? Assets are economical resources that are expected to be of benefit in the future. Cash, merchandise, inventory, furniture, and land are assets. Claims to those assets come from two sources. Liabilities are outsider claims, debts that are payable to outsider. These outside parties are called creditors. Insider claims to Amazon.com's assets are called owner's equity or capital. These insider claims are held by the owners of the business. Owners have a claim to some of the assets because they have invested in the business. If you look at here, you can see assets equal liabilities plus owner's equity. Owner's equity consists of capital minus withdrawals plus revenues minus expenses. You can see the things that sort of increases owner's equity are revenues and owner investment in the business. And other things that decreases owner's equity are owner's withdrawals from the business and expenses. For example, if the assets of a business are $170,000 and the liability total $80,000, how much is the owner equity? We should write the accounting equation, which is assets minus liability equal owner's equity. We have the liability, which is 170,000 minus liabilities, which is $80,000. It gives us $90,000. Let's go to the next example. If the owner's equity in a business is $22,000 and the liabilities are $36,000, how much are the assets? In this example, we have owner's equity, which is $22,000, and we have liabilities, which is $36,000. So we should add these two to give us the assets, which is $58,000. Accounting for business transactions. Accountants' records are based on actual transaction. A transaction is any event that affects the financial position of the business and can be recorded reliably. Many events affect a company, including elections and economic booms. Accountants do not record the effects of those events because they can't be measured reliably. Okay, this was all. Thanks for your attention. Let's go to Kian. Thank you.
Thank you very much, Sama. Hello, everyone. I'm Kian Mahmoudpour. I'm going to be with you in the second part of the chapter one, and I'm going to analyze and explain an example for you. And after that, I'm going to talk about the financial statements. So let's start. Before we check example, let me talk about business transactions. Actually, accounting records are based on actual transaction. But what is transaction? Transaction is any event that affects the financial position of the business and should be recorded reliably. Perhaps many events affect on company, such as inflation, economic booms, elections, or etc. But actually, accountants don't record these items. You know why? Because when we say something is business transaction, first of all, that event must be related to the business. After that, the event must be reliable. Then cashing that transaction must have been transferred. And finally, with all these items, accountants can call that event business transaction and record it in the books. So it is important that you realize that every transaction is not a business transaction. On this page, we have an example, and we have to be careful. We have to analyze different transactions for Gagelen e-travel company. In first transaction, Gagelen start the business and invest in $30,000 on cash. Here in this transaction, Gagelen invests in the business. So on the left side of accounting equation that it is asset, our cash account increased because cash is subset of assets on the left side. And on the right side of accounting equation, capital increased $30,000. And capital is, you know, is subset of owner's equity on the right side. And finally, as a point, you should know that after each transaction, the left side and right side of accounting equation must be completely equal. Here on this page, we have Gagelen e-Travel's balance sheet. Balance sheet is one of the most important financial statements that shows the financial position of business in one moment. Balance sheet, or also we can say statement of financial position, we cover it on the next pages, but for now it is necessary for you to know that on the left side of balance sheet we have only assets, and on the right side we have liabilities and owner's equity. And exactly like accounting equation, in balance sheet, left side and right side should completely be equal. And in this case, we can see $30,000 on asset side and $30,000 on the right side in balance sheet are equal. And in balance sheet, total assets should equal total liabilities plus owner's equity. And here you can see this point. On this page, you can see second transaction that Gagelen purchased land for an office location and she paying cash for of $20,000. In accounting, whenever we try to buy something, we can pay cash or we can buy it on account. Pay on account means buyer pay the seller later. Here in this case, Gagelen pay cash, so Gagelen's cash account decreased $20,000 and land account increased $20,000. If you notice, you can see this transaction only impressed the left side of the accounting equation, and right side didn't change. But still, the amount of the left side and right side is equal, and it is $30,000. On this page, again, we prepare Gagelen e-Travel's balance sheet after those transactions, and we can see cash account and land account on the asset side and Gagelen's capital on the right side. But still, the balance of balance sheet on both left and right side is $30,000 because in transaction 2, we saw that we just changed assets and we hadn't changed on the right side of accounting equation. In third transaction, Gillen purchased stationery and office supplies and agreed to pay $500 within 30 days. Here she purchased office supplies on account, so office supplies account increased $500 on the left side. And this account is subset of assets, and accounts payable increase 2 on the right side. And accounts payable is subset of liabilities because it means that Gillen promised to pay $500 in the next 3 days. Also, we can see after this transaction, the balance on the right side and left side is equal, and it is $30,500. Again, we can see Gillen's balance sheet in April 9 that office supplies appears of $500. On the asset or left side, and accounts payable appears at $500 on the liabilities or right side. And finally, total assets are equal total liabilities plus owner's equity. Then you can see it is $30,500. In next transaction, Gillen earned service revenue by providing travel services of $5,500 in cash. As you can see, both sides of accounting equation increase. On the left side, cash is subset of asset and it increased because Gillen's business received cash. And on the right side, service revenue is subset of capital and it increased too, because $5,500 cash by preparing services received from client. And the balance of both left and right side are $36,000. In transaction 5, Gillen performed service for clients, but client didn't pay anything and they promised pay $3,000 within 1 month. Accounts receivable that it is subset of asset increased $3,000 on the left side because the business received $3,000 cash in the future. Also, service revenue that I talked about it in the last transaction increased $3,000 because the business performed services for its client. So the balance of the left side and right side in the accounting equation become $39,000. In the next event, Gillen pays $3,300 cash expenses. Of that $3,300, $600 was computer leasing, $1,100 was office rent, $1,200 was salary expense, and $400 was for utilities expense. On the left side, assets decrease. You know why? Because Gillen pay expenses in cash. Well, cash account decreased $3,300. Also, on the right side, expenses are subset of owner's capital. So the capital is decreased too of $3,300. Of course, I have to mention that the expenses themselves increase of $3,300, but the capital will decrease finally. And finally, the balances of the both sides are $35,700. Here on this page, we have income statement. Income statement is another financial statement that companies usually prepare it at end of the accounting period, and it shows companies' net income or net loss during the period. In income statement, we subtract all expenses from all revenues, and if the digit of revenues were bigger than expenses, our result will be net income. But vice versa, if the number of all expenses were bigger than revenues, we have net loss. Also, you can see that in Gillen's business, we have $5,200 net income because Gillen's revenue is $8,500. It is bigger than all expenses. And finally, we have net income. In this transaction, Gillen pays $300 to the store where she purchased $500 of office supplies in transaction 3. So she has paid part of her debt of $300. Well, we decrease cash account because the owner paid on account. Also, we decrease accounts payable of $300 because part of our debt has been cleared. But still, Gillen has $200 debt that she must pay in the future. In transaction 8, Gillen remodeled her home at cost of $40,000 and paying cash from personal funds. If you pay attention here, you can find out that this transaction is not related to Gillen Travels company, and it has related with Gillen's personal affairs. So we don't record the transaction in the books. In transaction 9, Gillen received and collect $1,000 from client that Gillen's company performed services on account in transaction 5. Here we received cash, so cash account increased $1,000. On other hand, $1,000 of our receivables have been received, so we decreased accounts receivables of $1,000. Finally, if you notice here, you can understand that only assets account are involved, I mean cash and accounts receivable. In transaction 10, Gillen sells some of the company's land and received $9,000 cash. Gillen received cash, then our cash account increased $9,000, and Gillen sells some of her land. It means that she no longer has some land. So we decrease land account $9,000 on the left side, and exactly like last transaction, I have to mention that one asset account increase, I mean cash, and another one decrease, I mean land. In the final transaction, Gillen withdraws $2,000 cash from the business for personal use. So we decrease cash account of $2,000 on the left side, and we create withdrawal account of $2,000 on the right side. Be careful that owner withdrawal, expenses, revenues, and owner investment, we can also call it owner capital, are subset of owner's equity. What about revenues and owner investment? When they increase, owner equity increase too. But about owner withdrawal and expenses, when they increase, eventually owner's equity decrease. And finally, in accounting, we have 4 important financial statements, including income statement or statement of operation, statement of owner's equity, balance sheet, or also we can call it statement of financial position, and the last one is statement of cash flow. So let's analyze what are these financial statements in the next pages. The income statement presents a summary of an entity's revenues and expenses for a specific period of time, such as a month or a year. The income statement, also called the statement of earnings or statement of operation, is like a video that it is present a moving picture of operation during a period. Also, this statement holds one of the most important pieces of information about the business. I mean net income or net loss. If total revenues greater than total expenses, we have net income. And vice versa. If total expenses greater than total revenues, we have net loss. And finally, I have to mention that net income is good news about operation for the company, and net loss is bad news for operation of our business and company. After we prepare income statement, we can provide the statement of owner's equity. This statement shows the changes in owner's equity during a specific time period, such as a month or a year. And finally, owner investments and net income increases owner's equity because they are involved in statement of owner's equity. but owner withdrawals and net loss decreases owner's equity. And these accounts also involved in the statement of owner's equity. Balance sheet, or also called the statement of financial position, lists assets on the left side, but liabilities and owner's equity on the right side, as of a specific date. Actually, these financial statements, unlike income statements and a statement of owner's equity, shows the entity like a snapshot or photo in one moment. And also, this specific date is usually the end of a month or a year. And I completely explain it for Gable and Travels, that what is balance sheet and net income for that period and during the period for income statement. And the last financial statement is the statement of cash flow. In the statement of cash flow, we have three important activities, including operation activities, investing activities, and financing activities. Basically, this statement reports cash receipts and cash payments during a period. And finally, if business activities results in a net cash inflow, it means receipts greater than payments, and vice versa. If business activity results in a net cash outflow, it means payments greater than receipts. And we have, unfortunately, cash outflow. Well, it was the second part of the chapter 1. I hope you enjoyed. Thank you for your attention. My friend Danyal is going to explain the next part. Thank you very much.
Hello everyone, my name is Danyal Talebpour, and as does the rest of the team, I'm a accounting undergraduate in the University of Kurdistan. For the last part of our lecture, and as Kian and Sama explained, I'm going to continue our financial statements. The next topic is financial statement headings. In each financial statement, there are three pieces of information. The first one is the name of the business. For example, Gillen e-Travel. And then the name of the financial statement. We had 4 financial statements, if you remember. And finally, the date or time period covered by this statement. For balance sheet, we had a snapshot, a moment in time. And as for the rest, we had a period. In this page, we're going to examine the relationships that exist among the financial statement. In other words, we're going to show you how financial statement is prepared, and one cannot exist without the others, and you're going to find out why. Usually, the first financial statement that we prepare is the income statement. And in here, we're going to prepare it for the month ended April 30th, 20x5. First, you need to know that it reports revenues and expenses. Expenses are listed in decreasing order of their amount, with the largest expense first. Then the next point reports net income of the period, and if total revenues exceed total expenses, or if total expenses exceeds total revenue, it's a net loss. In any case, net revenue or net loss is needed to prepare the statement of owner's equity. That's why we're going to prepare it in order. First, the income statement, then the statement of owner's equity, and finally, the balance sheet. In any case, for the statement of owner's equity, which is for the month ended April 30th, 20x5, first, we're going to bring the owner's capital balance at the beginning of the period. Then we're going to add investments or also net income or net loss. That I said earlier, we're going to need it for this part. And then we're going to subtract any withdrawals by the owner. Finally, we have the capital balance at the end of the period. The next one is balance sheet. We're going to use the capital, the owner's capital balance at the end of the period for our balance sheet. You see, they're related to each other. That's why I said one cannot exist without the others. In any case, for balance sheet, and at April 30, 20x5, it reports all assets, liabilities, and owner's equity. Assets on the left side and liabilities and owner's equity on the right side. Then we're gonna calculate the amounts, the total amounts of assets and liabilities and owner's equity. These two sides must always be equal because of the accounting equation. And finally, we're going to bring the balance amount of our owner's equity, capital, and then we're going to do the rest. As for the statement of cash flows, we're going to need the cash amounts. It reports cash flows from three types of business: operating, investing, and of course, financial activities during every month that is covered in this statement. For now, we're gonna teach you this cash flows very briefly because we're gonna focus on it later in the upcoming chapters. In any case, in the next page, you see this is the accounting equation that Kian explained to you, all the 11 parts. And now in this page, you see here, we have the balance amounts of both assets and own liabilities and owner's equity. They must be always equal. You need to remember that. It's a code among our accountants. And now we're going to prepare, and you see the form of the statements. The first one is income statement. First, the name of the company or business. Then we're going to state the type of our statement, which is income statement, and then the time or period it's covered. Anyway, first we bring our revenues. In this case, it's a revenue. It could be a sales revenue as well. But for this company, it's a service performing company. And its amount is $8,500. Then we bring our expenses. We had salary expense, rent expense, lease expense, utilities. And if you sum all these expenses, you have a total expense of $3,300. If you subtract this amount from our total revenue, we're going to have a net income, $5,200. We're going to use our net income in here, our statement of owner's equity. First, we're going to bring the given capital for the beginning of the period. In this case, it's 0. Then we're going to add investments and net income, the net income that we calculated in the previous page. And when we subtract our withdrawals by the owner, we're going to have given capital for the end of the period, the balance amount, which is $33,200. The next page is for balance sheet. Giggling e-travel balance sheet, April 30th, 20x5. On the left side, we have assets. The total assets is $33,400. And on the right side, we have liabilities and owner's equity. You see giggling capital is used in here. There are 2 stars beneath it. In any case, as I told you earlier, total assets must always equal total liabilities and owner's equity. You need to remember that. And finally, we're gonna prepare a statement of cash flows. All you need is an insight. You don't have to bother yourselves to fully understand this part. First, we have cash flows from operating activities. We have receipts and payments. Receipts are cash that we received, and payments are cash that we paid. We have receipts collection from customers. We performed services and we received cash. And for our payments, we had expenses such as supplies and salaries for our employees. In any case, if we subtract this amount from our receipts, we have a net cash inflow. We received this cash from operating activities, which is $2,900. For cash flows from investing activities, the next one, we had an acquisition of land. We paid and we acquired land. And then the sale of land. We sold a piece of land. So the resulting amount will be 11,000. It's a net cash outflow. The money has been exited. And for the next cash flow, it's for financial activities, for investment by owner or withdrawals by owner. And again, we have a net cash flow from financing activities, $19,000, $19,900. Then for net increase, if we add our cash balance at the beginning of the period, we're going to have the cash balance at the end of the period, which is $19,900. Now we have almost covered every part in this chapter. I'm gonna solve an example for further comprehension. It says here, Jill Smith opens an apartment locator business near a college campus. She is the sole owner of the proprietorship, which she names Campus Apartment Locators. During the first month of the operations, July 26, she engages in the following transactions. There are 9 transactions, A to I. And in this page, first, we're gonna prepare an accounting equation, as you see here. Then let's see what are the transactions. The first one says Smith invests $35,000 of personal funds to start the business. So we're gonna acquire some money to start the business. In other words, our cash, this column here, our cash increases for $35,000. And of course, our Jill Smith capital increases for the same amount. And as I said 100 times before, they must be always equal, both assets amount and liabilities and owner's equity. The next transaction says she purchases on account office supplies costing $350. In other words, we acquired some office supplies worth of $350. And on the other side of the accounting equation, we had liabilities because it was on account. It's a debt. So accounts payable increases for the same amount. The next one says Smith pays cash of $30,000 to acquire a lot next to the campus. She intends to use the land as a future building site for her business office. In these transactions, if you pay attention, we paid money and acquired land. In other words, an asset transforms to another asset. So our cash decreases for $30,000. And on the other hand, our land increases for the same amount. And as you see, our accounting equation is equal again. For the next one, Smith locates apartments for clients and receives cash of $1,900. In other words, she performed service. So our cash increases for $1,900. And on the other side, our Jill Smith capital increases for the same amount. It's a service revenue. For the next one, she pays $100 on the account payable she created in transaction B. If you remember, we had a debt in transaction B worth of $350. She pays off her debts, so our cash decreases because it's a payment. And of course, our accounts payable decreases for the same amount because she paid off her debt. The next transactions, she pays $2,000 of personal funds for a vacation. As you might notice, this transaction doesn't concern our business, our company. So we're gonna not record these transactions. We're gonna ignore it, skip it, because it's a personal transaction. And the next one, G, she pays cash expenses for office rent $400 and utilities $100. It's a payment for expenses. In other words, our cash decreases $400 and another $800. And on the other hand, our Jill Smith capital decreases for the same amount because we paid some expenses. And then the business sells office supplies to another business for its cost of $150. We sold our supplies, office supplies. So obviously our office supplies decreases, and on the other hand, our cash increases. It's a asset transformation. We transform our office supplies to cash. And finally, Smith withdraws cash of $1,200 for personal use. It's a withdrawals. So our cash decreases $1,200, and obviously, because it's a withdrawals, our capital decreases for the same amount. And then we're gonna calculate the balance amount. It is $35,450 for our assets, and the same amount for our liabilities and owner's equity. In other words, we have been true to our transactions. Now it's time to prepare our statements. As I said earlier, the first one we usually prepare is the income statement because we need the net income or net loss in order to prepare the rest of the statements. So as you see here, first the name of the business, campus, apartment, locator, then the type of the statement, which in this case it's income statement, and then the date or time that is covered. Month ended July 31, 20x6. First, we have our revenues, which in this case it's a service revenue, $1,900. Then we have our expenses, two expenses, rent and utilities. And if we sum these two, we have a total expense of $500. And if we subtract our expenses from our revenues, we have a net income worth of $1,400. We're going to use our net income here. The next one is statement of owner's equity. First, we're going to bring Jill Smith's capital in the beginning of the period. It was 0. We had no capital. Then we're going to add investments or net income or net loss. If you have net income, we're going to add it to this amount. And if you have a net loss, we're going to subtract it from this amount. In any case, if we subtract withdrawals from it, we have Jill Smith's capital, July 31, 20x6, the end of the period, worth of $35,200. We're going to use this capital balance in the next statement, which is balance sheet. For July 31, 20x6, a snapshot, a moment in time. On the left side, we have assets, cash, office supplies, and land. The total assets is $35,450. And for liabilities, we had accounts payable. At the first, we have $350. Then $100 was subtracted from it. She paid off her debt. And then for our owner's equity, we had Jill Smith capital. We use this amount in here, $35,200. And then if we sum total liabilities and owner's equity, we have the same amount as the left side. In other words, no errors were made during this period. And this was the end. Thank you so much for your attention. See you next time.
Thank you very much. Thank you for your attention. I hope you enjoyed this chapter. Thank you.
Thanks, Kian and Daniel, for your energy and great explanation. Okay, that was chapter 1, business and the living environment. If you have any questions, feel free to communicate with us via our email addresses. And also special thanks to Dr.RezaZarei for his support. So in our next video, we will speak about recording transactions and also describe financial statements. Stay tuned.